Welcome back to our channel. Today we've got some great news for potential homebuyers out there. The Federal Housing Financial Agency, or FHFA, has made a significant shift in policy that's all set to have an impact on your mortgage plans. The agency has decided to revoke a proposed mortgage fee that would have affected people with certain debt-to-income ratios. Let's dive into what this means for you. So, before we progress further into the video, it's essential we understand some key terms, especially for those who are new to the world of real estate and finance. One of the most crucial terms here is debt-to-income ratio, or DTI for short. The DTI is a personal finance measure that compares an individual's debt payment to their overall income. It's calculated by adding up all your monthly debt payments and then dividing that by your pre-tax monthly income. So if you're paying $1,000 a month towards various debts and you're bringing in $4,000 a month, your DTI would be 25%. Now, these debts generally include your recurring expenses. We're talking about your mortgage payments, your rent, or even those pesky student loans. Essentially, it's any financial obligation that requires you to make regular payments. This DTI ratio is a key factor lenders use when you're applying for a mortgage. It helps them understand how much of your income is already tied up in debt and whether you can afford to take on a mortgage. Now, the fee we're discussing was planned to target those with a DTI ratio exceeding 40%. In simpler terms, this fee was meant for individuals whose debt payments constituted over 40% of their income. This proposed fee was not everything, however. It was a part of a larger set of changes that also involved factors like credit score and the size of the loan. These changes were all slated to begin from May 1st. However, with the recent announcement from the FHFA, the fee based on the DTI ratio has been canceled, bringing relief to a considerable number of potential homebuyers. Congressman Warren Davidson, who is not just a member of the U.S. House of Representatives, but also serves as the chairman of the Subcommittee on Housing and Insurance, has been a strong critic of this proposed fee. From the outset, he has publicly voiced his opposition to this plan, making it clear that he believed it would negatively affect potential mortgage borrowers. Davidson's concerns were primarily rooted in the potential financial burden that this fee could impose. He argued that introducing an additional upfront cost for those with a DTI ratio of over 40% could potentially discourage many from pursuing homeownership or refinancing an existing mortgage. He contended that such a fee could unfairly penalize people who are managing their debts responsibly, but happen to have a higher DTI ratio due to factors such as living in high-cost areas, having student loans, or experiencing temporary fluctuations in income. Davidson's opposition wasn't just a matter of public statements. As the chairman of the Subcommittee on Housing and Insurance, he holds a significant role in shaping housing policies and thus has been able to articulate his concerns to the FHFA and advocate for the interests of potential mortgage borrowers at a policy level. The decision to cancel the proposed DTI ratio fee suggests that they've listened to the arguments put forward by Davidson and others who have opposed this fee. The cancellation of this fee indicates a willingness on the part of the FHFA to reconsider and adjust their policies in response to feedback and to the potential impacts on borrowers. So how exactly would this DTI ratio fee have affected borrowers? If you had a DTI ratio above 40% and this fee had come into effect, it would have meant that an extra 0.375% would have been added to your home loan. This additional fee would apply to loans that were intended to be sold to either Fannie Mae or Freddie Mac, the two government-sponsored entities that back a large portion of U.S. mortgages. Let's break down what this would look like in real-world figures. If you were taking out a home loan for $300,000, the addition of this fee would have resulted in an extra cost of $1,125. And this isn't a fee that you could pay off over time. It would have been required upfront when closing the loan. For many homebuyers, especially those already stretching their budget to afford a home, this added cost could have been a significant financial burden. Now, if you were unable or unwilling to pay this additional fee upfront, you had another option. You could have chosen to increase your mortgage's interest rate to offset this cost. While this could have helped you avoid the immediate outlay of cash, it wouldn't have saved you money in the long run. In fact, it would have ended up costing you an extra $24.75 per month. While that might not seem like that much on a monthly basis, let's look at the long-term impact. Over the span of a 30-year mortgage, you would have ended up paying almost $9,000 more than you would have without the fee. That's a significant amount of money that could have been better spent on home improvements, saved for a rainy day, or invest for future growth. Therefore, the cancellation of this fee is indeed a big win for potential homebuyers who would have been affected by it. Let's look at the arguments that were set forth against the fee. Firstly, the use of the DTI ratio as a standalone measure of a borrower's ability to repay loans was seen as problematic by many in the industry. Robert Brooksmith, the president and CEO of the Mortgage Bankers Association, has been vocal about this issue. Robert's argument revolves around the fact that the DTI ratio, while a valuable tool in assessing a borrower's financial health, is not necessarily a comprehensive indicator of their ability to manage a mortgage. The DTI ratio doesn't take into account other factors such as savings, other assets, job stability, or potential for future income growth. These factors can also significantly impact a borrower's ability to meet their mortgage obligations. Next, we have the issue of fairness. A high DTI ratio doesn't automatically equate to financial irresponsibility. For example, consider a couple with a near-perfect credit score, no credit card debt, a history of timely bill payments, but a DTI ratio of 41%, just over the threshold. This could be due to factors beyond their control, such as high student loan payments or living in an area with a high cost of living. This couple would have been unfairly penalized with the DTI ratio fee, despite demonstrating financial responsibility in other areas. What's more, the addition of this fee to their home loan would actually increase their DTI ratio, potentially making it even harder for them to secure other types of credit in the future. The proposed DTI ratio fee would have created a series of challenges for lenders as well. The very nature of income and expenses is dynamic. They are subject to change, sometimes more than once, throughout the loan process. This is particularly true given the changing landscape of employment in recent years. The rise of self-employment, part-time work, and gig economy roles has made income streams more variable and less predictable than traditional full-time employment. For instance, a freelance graphic designer or a rideshare driver may have months where they earn significantly more than others, and their expenses can fluctuate just as dramatically, perhaps due to business-related costs or irregular work hours. For lenders, managing these changes can be a significant challenge. If a borrower's DTI ratio changes throughout the loan process, it could necessitate multiple adjustments to the loan's pricing. This would not only add complexities to the process, but it could also potentially lead to difficulties in complying with rules about loan revisions or cause delays in the closing process. Moreover, the risk of multiple pricing changes could potentially jeopardize the trust between the borrower and the lender. From a borrower's perspective, it could appear as if the lender is implementing a bait-and-switch strategy, offering one loan price initially and then increasing it as the process goes on. This could potentially harm the lender's reputation and erode customer trust, which is crucial in the mortgage industry. In essence, the cancellation of the DTI fee helps maintain the integrity of the lending process, reducing potential complications and maintaining trust between lenders and borrowers. Lenders deeply value their reputation and the trust of their clients, as these are foundational to their business. The possibility of being accused of such tactics was a serious concern, and one that many felt needed to be addressed. The cancellation of the DTI fee, therefore, not only benefits borrowers, but also supports lenders in maintaining a transparent, trustworthy, and efficient lending process. So, what does the future hold? Now that the proposed DTI ratio fee has been canceled, attention within the industry and among policymakers has turned to other changes that the FHFA implemented on May 1st. These changes revolve around fees based on two key factors: credit scores and down payment sizes. What do these changes mean for potential borrowers? For some, the new fee structure could result in higher costs. Even individuals with high credit scores could end up paying more than they would have before these changes came into effect. This could seem counterintuitive, as traditionally, a higher credit score is associated with lower borrowing costs due to the decreased risk these borrowers pose to lenders. Conversely, the changes have also resulted in some relief for those with lower credit scores. The penalty that was previously imposed for having a lower credit score has been reduced, meaning these borrowers might not face as steep an increase in costs as they would have prior to May 1st. This fee restructuring has sparked debate within Congress. Congressman Patrick McHenry, chairman of the House Financial Services Committee, has been an outspoken critic of the new fee structure. He views these changes as a tax on credit-worthy borrowers. In essence, his argument is that these changes penalize those who have demonstrated responsible financial behavior and earned strong credit scores. This perspective raises questions about the fairness and effectiveness of the new fee structure. Should those who have demonstrated financial responsibility be subject to higher costs? Is this an effective way to balance the risks inherent in mortgage lending? These are questions that lawmakers, industry stakeholders, and potential borrowers will be grappling with in the coming months. Meanwhile, the FHFA has signaled that it's moving forward to more dialogues with industry stakeholders about setting fees and gathering public opinions. They've announced that they'll soon release details about an upcoming request for input on a fee pricing framework. As we await those details, it is clear that the conversation around mortgage fees is far from over. So for those of you who are planning to buy a house or looking to refinance your mortgage, this news from FHFA is a positive step. It seems that the agency has heard the concerns of potential borrowers and lenders, and they're making adjustments accordingly. In summary, the revoked DTI ratio fee would have placed an additional financial burden on certain borrowers and created unnecessary complications for lenders. Its cancellation comes as a significant relief for many, particularly for those with a DTI ratio over 40%. The move underscores the importance of fairness in the lending process and highlights the need for more nuanced measures of a borrower's ability to repay loans. That's all for today's real estate news update. Remember to subscribe to our channel to stay up to date on all things related to home buying, selling, and investing. And as always, if you have any questions, leave them in the comment section below, and we'll do our best to answer them in our upcoming videos. Until next time, happy home hunting and selling!